I'm super excited to talk about multifamily investment properties with the team. And for today, I wanted to share a little bit about my background. I know everybody here knows me, but I wanted to share some of my investment property journey and background. And then the objectives for today is to share an introduction on multifamily homes and how they're different than single unit homes, which is the majority of what we think about today. And then also understand how to underwrite a multifamily investment property because the buyers that you're going to work with for multifamily homes are going to be more analytical and ultimately it's going to come down to the numbers. So I wanted to share how to think about that. But jumping into my background a little bit, I think you all know a pretty analytical mindset, but just wanted to share it comes from the world of consulting and tech and VC now merged with real estate. And I personally am a San Francisco real estate investor, and I own and manage over 20 units in the city, a mix of both residential, so 2 to 4 unit properties, as well as commercial, so 5+ units in the city. So wanted to start with a quick market overview, and we'll keep this pretty simple. But overall, I've personally picked up a lot of my multifamily units in the past couple of years because it is a good time to buy multifamilies in San Francisco right now. And we'll look at a couple charts thanks to Compass. And here I have it broken down by 2 to 4 units. And I'll keep saying this because 2 to 4 units is considered a residential property. And that mostly ties into financing. So you'll get a regular residential loan if you're looking at a 2 to 4 unit property. And then if it goes into 5 units or more, then that gets into the commercial world, which is a little bit trickier. And we'll chat about that as well. But at a high level, you can see with these charts that over the last couple of years, property prices for 2 to 4 unit homes have decreased. So both median sales price as well as average dollars per square foot. And that's mostly driven by interest rates. Similarly, for looking at 5+ units, the chart on the left you'll see is a measure called cap rate. And we'll talk about that more after and how to calculate that and what that means. But you'll see that cap rates have been increasing, which is directly inversely related to property prices. So the left-hand chart is saying that prices have dropped. And similarly, on the right-hand side, dollars per square foot for 5+ units have also decreased. One important thing to note, though, is that even though prices have decreased, rents are still quite strong in San Francisco, and I've seen that in the rental market, when I'm renting out my units. So, of course, rental prices dropped a little bit during COVID, but it's mostly bounced back. And I would say the rental market is pretty strong these days. So the reason why at a high level it's good to buy right now is that prices for these buildings have dropped, but the rents that you're collecting have stayed mostly the same. So ultimately, the numbers are better. So let's dive into how multifamily is different than single unit homes. And I've broken this down by a couple buckets. First is definition, then we'll talk about sourcing and due diligence. And then the last part we'll talk about is financing. And that's pretty different in the multifamily world. So by definition, we've already talked about that. The 2 to 4 units stays mostly in the residential world, similar loans, and your lenders will kind of think about them very similarly to single unit homes. When you get in the 5+ units, that's a commercial loan, and that's a little bit different. Again, the buyers here are going to be more investment and numbers focused. So ultimately, it's going to come down to the numbers. So talking about sourcing and due diligence, I did want to talk about sourcing a little bit. There's a couple different tools, like most homes are still going to be on MLS, Zillow, Redfin, all of the tools that you work with day to day. But there's also a couple more commercial focused tools and websites called LoopNet, for example, and that's kind of fun to browse. Sometimes they'll also have more information on a website like LoopNet. They'll have what's called the offering memorandum like attached directly there. So it's a bit easier for even buyers to navigate directly themselves versus having to ask their agent to ask the listing agent for information. And I've also found that for multifamily properties and usually larger buildings, there's also some more off-market opportunities. So a little bit relationship driven. You can get on different newsletters by listing agents who do a lot of multifamily sales in San Francisco, and they'll just send you things like mostly on market, but I do think there are some additional off-market opportunities for buildings that might be a little bit trickier to sell, or I've gotten the reason that there's 12 sellers involved and they just don't want to deal with putting it on the market. So I think you will see a little bit more of that in the larger multifamily world. Another thing that I find interesting is that location matters, but ultimately it just comes down to the numbers because things are priced in. Like you want to buy in a place that will continue to collect strong rental income, but ultimately, like if it's a medium quality location, not top tier location, you'll collect a little bit less rent, but that's all going to be priced into the purchase price. So I think location does matter, but ultimately, if it's a good enough location, and you're able to collect good enough rents, that should all be priced into the purchase price, and that might still be a good investment property. Going back to pricing, multifamily properties are also generally priced closer to where they are expected to sell. Of course, things can sell above list price, but we don't usually see like 30 to 40% over list price or as much of a bidding war these days. So it's a little bit less competitive, and generally they're priced closer to where they're expected to sell. And then, yeah, I like to say that there's no deals in life, but generally, again, everything is priced in. If you see a 8-unit property listed for $1.5 million in San Francisco, it's likely because they have a lot of rent-controlled units and a lot of tenants who are not paying very much rent. So everything is priced in. And again, going back to the numbers, you'll just have to see where the numbers shake out. But generally, that's the reason you'll see some well-priced properties in San Francisco. Another difference is that the inspection contingency is actually more typical to keep when looking at multifamily properties because we're used to a very full disclosure packet when looking at single unit homes. All inspections are completed, everything's like tied up with a nice bow, but that's not usually the case for multifamily properties. Oftentimes they would not have even done the inspection yet, and that's pretty typical. So usually you would come in with a contingent offer and then do your own inspection. So the buyer would pay for the inspection and then be able to make a final decision after completing their own inspection. And generally, it is more typical to negotiate for seller credit because the inspection hasn't been completed beforehand. So when submitting the offer, yeah, the listing agent is not going to be scared away by like a 10-day inspection contingency, for example. And I find that to be pretty beneficial because then, we're able to use Chester or someone that we like to do a really deep dive on the property. So to talk about financing a little bit, and there's a couple terms here which we'll dive into and explain in more detail after. I know it's a lot of information. But the financing is probably one of the bigger differences for multifamily properties where generally financing is a bit more casual and relationship based. So you don't usually get a pre-approval letter. You can usually get what's called an LOI, a letter of intent from a banker. That just means that they say they're interested in financing this property for you, but you have not been like fully pre-approved. And that's because the lenders, similar to what we look at, is ultimately going to look at the numbers on the property. What's the rental income? What are the expenses? So they don't necessarily care about your credit score or like the buyer's credit score or the buyer's background. Like it's good. They'll definitely still check and still pull credit scores. But they're going to care a lot more about what the building is producing and what the numbers look like there. So more about the building than the buyer itself. For days to close, this is also much longer than a typical single unit home. It's going to take about 50 to 60 days. I think some lenders even ask for more just because it takes them, I think, a little too long. But to underwrite the property, it takes them a bit longer to do the appraisal because they'll have to get a commercial appraiser to look at all the different properties, do their own comps, rental comps, and then kind of build out all the expenses for the property. For commercial, the other big thing is generally more down payment is needed for a commercial property. And this ties back into the underwriting, which is based on what is called a debt service coverage ratio, DSCR. So when a lender is underwriting the property, they're going to want to make sure you have more than enough money to cover the debt servicing for the property. And that's not just at 100%. They usually want to see 1.2 to 1.3%. So they want to see that the building is generating 20 to 30% more income than what's needed to cover the financing. So they're generally pretty conservative, and that's why they want to see the 1.2 to 1.3x. And then that, so they're basically discounting how much rental income you're getting to make sure that they're being conservative and that you can actually pay your monthly mortgage. So due to that debt service coverage ratio, that means that you're generally going to have to put more money down because they're not going to finance as much of the property. The financing terms are also a little bit different. Usually it's more a 5 to 7 year term versus, the 30-year term that we're used to for single unit homes. But it will still be amortized over 25 or 30 years. So your monthly payments is going to be based on a 30-year amortization. So the monthly payments is not going to be, I guess, like much larger than a normal single unit home, but the term is going to be 5 to 7 years. So that means that after 5 to 7 years, you're going to have to pay off the loan, likely with the refinancing or another loan. Another aspect that's more typical that we see in commercial lending is prepayment penalties. So that is kind of exactly what it sounds like. Even if it's a 5 to 7 year term, usually the fixed interest payments are going to, the fixed interest rate is only going to be for 1 to 3 years. So all in negotiation when you are talking with a lender, and that kind of brings it back to being relationship driven. So I think you'll talk to different lenders. The more you work with a lender, the better terms you'll get. But prepayment penalties and the term and amortization are all things that you can negotiate as well. And the last thing we'll touch on for financing is a bridge loan versus a commercial loan for stabilized properties. So one thing that's interesting is because these lenders are pretty conservative, they like to see a building that is fully occupied and that has actual recurring revenue that's been like pretty stable the last couple of years. So if you buy a property that has a couple vacant units, some lenders might not want to give you a regular commercial loan up front because they want to see that you can actually rent out the units at the rent that you're saying. So I had to do this for the 9 unit that I bought last year because a couple units were vacant, which is good for me as a buyer because then I can rent it out at market rate and collect more rent for it. But in order to purchase the property, I had to get what's called a bridge loan. So this is a hard money loan. It's from usually like a wealthy individual who is less conservative on underwriting the loan, but they're going to charge you a higher interest rate because they're taking on a higher risk buyer or property, for example. So another option with multifamilies, especially if it's a unit that has a couple of vacant units, is that you might have to consider a bridge loan, which is going to be at a higher interest rate. And you can do that for 6 months to a year before you stabilize the property and then move to a regular commercial loan. Any questions at the moment? I know there's a lot of information before I get into some of these terms.
Caley, a question. I'm sorry if I missed it. For the bridge loan and stabilizing a property, is that a commercial like 5+ units, or is it also true for 2 to 4?
Yeah, good question. So anyone can get a bridge loan for a variety of different reasons. So the bridge loan is not just for the commercial world. Yeah, like an individual can get a bridge loan if, for example, they need I think a good example for single unit properties is if someone needs to sell their property before buying their next property, but then they, got in contract with the new property that they liked, but they don't have the cash yet. They might need to get a bridge loan to purchase the new property, and they're able to get this at a higher interest rate before selling their existing property. So yeah, it can be for a variety of reasons and not specific to commercial.
Yeah, just I've used it on residential single unit. I guess my question is, does the you mentioned the reason some people need to get a bridge for multi family is because the building's not quote unquote stabilized because some of the units are open. Is that true for 2 to 4? as well. So if you buy a 2 to 4 and 2 units are open, some lenders might bulk at that and ask you to get a bridge loan to stabilize it before.
Yeah, it's a good question. I think it's going to be property dependent because for 2 to 4 units, the lender is going to care more about the buyer themselves. So if you're someone who has like good credit score and like a good credit history, I think they might be more open to lending on a 2 to 4 unit, even if two of the units are vacant.
Okay, so it is a little bit different.
It
Got
is a
it.
little different, yeah, because they care more about the building when it's commercial versus residential. And yeah, I guess an example for my personal experience is yeah, of the 4 unit I purchased was fully vacant when I bought it, and that wasn't an issue when I got my loan.
Okay, thank you.
Yeah, good question. So just taking a peek at time. So there's a couple terms on here that we'll go through, and then I did want to spend a couple minutes in the investment model, which I found very fun. But I wanted to cover some of these terms before we jump into the model to talk about underwriting a property itself. So a couple important terms. One is net operating income. So that is going to be a metric that drives a lot of these other metrics underneath it. And this is just your gross rental income. So how much revenue can you make every year on rents minus operating expenses. So keep that in mind. And then that directly drives cap rates. So that was in the chart on one of the first pages. And cap rate is just net operating income divided by purchase price. So we were saying that cap rates have increased because purchase prices have decreased. And you'll see that relation here directly. So if the denominator purchase price decreases, the cap rate will be increasing. And that's what we've seen. Debt service coverage ratio, this one we had talked about a little bit earlier, is your net operating income divided by debt service. So here, the bank just wants to make sure that you can more than cover your annual loan payments, and they want this to be at 1.2 to 1.3. So again, the 20 to 30% buffer that the banks want you to see that you can actually more than cover your debt servicing. I think the other two are more self-explanatory, so let's jump into the model.
So Caley, given that purchase prices have gone down, but rent has stayed stable, are you seeing a lot more competition for these type of opportunities?
Yeah, it's a good question. I think it's multifamily have gotten less competitive because even though like I think ultimately the numbers are better, but your financing has increased a bit. So the numbers
Mm,
are still better, but you're paying more in financing. And I think a lot of folks they are used to loans, they got like 5 to 10 years ago at a low interest rate, and now when their loan is up and they have to refinance, they can't actually afford to refinance. And part of the reason for that is there's financial engineering that you can do where when the interest rates were really good and the prices of the values of their homes were high, they did like what's called a cash out refi. So they pulled money out of the home. And some people over leveraged themselves and they pulled too much money out of the home. And now the home is not worth as much. So they actually can't even afford to, if they sold their home at their current price, they're already taking a loss on the property. So you'll see that there's a good amount of inventory, I would say, but it hasn't been that competitive, mostly due to interest rates.
okay, makes sense.
So I will share this link with everybody. But here is an example investment model that I tried to keep simple. But I know there's a lot going on here, and you'll see that there's two tabs, one for residential, 1 to 4 units. You can use it for 1 units as well. So yeah, 1 to 4 units, and then commercial 5+ units. And here you'll see blue, green, and black fields. So blue is the input or assumptions. You want to edit these as you go through it. Green is a reference from another cell, and black is a calculated field. So important thing to note is the blue text is what you should be editing and playing around with a little bit. So here I have a residential example. Let's say a $1.5 million property collects about $11,000 in rents. For expenses, I have a plug here for about 30%, which is pretty typical for multifamily properties. And then you'll see across the top here, it's kind of like a spread of, what if you purchased the property at 1.5 versus 1.4 versus 1.6, for example. So this is a good way to look at, so, plug in your numbers on the left-hand side here, and then I would focus on the 100% column as an example of how to look at the property, at least at a high level. So walking through this example, you'll see for this property, let's say okay, so this is 1 to 4. So I'm trying to think of what the easiest way to explain this is, because there's a lot of numbers here. So since it's a 1 to 4 unit, you can plug in what's called the loan to value. So this is what we're all pretty experienced with. You can usually get an 80% loan on the property and pay 20% down. So you can kind of play around with this number as well. But say it's an 80% loan, that means you get a $1.2 million loan. You're putting $330,000 down. Then that goes into the annual cash flow, where your monthly rent, you can plug this in based on the data that you have on the property, $11,000 a month minus 30% expenses. That means your net operating income is $7,700. And then this calculates a cap rate for you, which is at 6.2%, which is pretty high, and kind of where you want to be right now. And then it subtracts out all the financing based on the interest rates that you can plug in here, which I have at 6% for now, and then your monthly cash flow. So if this were the actual numbers of a investment property, you can expect to have an extra $500 in your pocket every month, which is the monthly cash flow. And then your annual cash flow would be about $6,000. Further down in the model, as you have your investor brain on, is, how much money can I actually make from this property if I were to hold it for 10 years and sell it at X price? So that's what the cash flow waterfall is down here. And again, these are all assumptions based, so you can kind of play around with it. But I find this part pretty interesting too. So assuming we're going to hold it for 10 years, this is the purchase price. These are the cash flows every year. The biggest question is like, what can I sell this property for in 10 years? And that we have a plug here as like an exit cap rate. So this is making an appreciation play right now. So right now, the average cap rate, let's say it's 6%. Let's say in 10 years, we think prices are going to come up again. So I have a plug here for a 5% cap rate, which means that, in 10 years, I bought this property for $1.5 million, but I think I'm going to sell it for $2.1 million. So looking at all the different cash flows with that assumption, that actually gets you to a 15% IRR, which is pretty strong. You can kind of compare this 15% IRR to, let's say, like the average 7% you can make in the stock market. So this is kind of 2x that, for example. But this is making an appreciation gain. So if you wanted to be more conservative, you can say, let's say we sell it for the same price in 10 years. So, we bought it at a 6.2% cap, but let's say that when we sell it, we're just going to sell it for a 6% cap. So just a small increase in price. So I'm going to sell it for $1.8 million instead. And that still gets you to a 10.9% IRR, which is still pretty strong. So in the last minutes, I wanted to talk about commercial and how it's a little bit different here as well. The main difference is the loan amount that you can get on a commercial property. So same plugs on the left-hand side of purchase price, rent amount, your exit cap here. But the main difference is how much of a loan you can actually get. So in this example, it's a $2.5 million property. We're collecting $18,000 in rent per month. This calculates the loan amount that you can get based on the debt service coverage ratio that we talked about. And here I have it at 1.3, which is being more conservative. So you can see that based on the 1.3 debt service coverage ratio, I can only get probably a $1.6 million loan on this property. So that's, let's see, a 64% loan. You can't really get the 80%. And that's generally what we're seeing. I think the higher side I've seen is probably 70% loan to value, but it's really rare to see the 80% loan to value because the banks are pretty conservative. So that means, for this property, you're going to have to put down $900,000. And that's one of the barriers to entry for multifamily, is that you usually do need to have more cash down. And it is, you have to be more capitalized to buy these properties. But similarly, so let's say, yeah, I plug these in to be around a 6% cap. So 6% cap financing. But here at a $2.5 million property, you can get almost $3,000 in cash flow per month. Yeah, and then similarly down here, we have a plug for a 5% cap rate. And yeah, you can kind of play around with the numbers. But yes, you get the gist there. I know we're at times, I want to be mindful of that as well. Any questions? And we can do a follow-up too if people have questions on the model, because I know we breezed through this.
This is great. I love the model. I'd love to also get a sense from you of, as you were walking, you were saying like, this is good, this is not good, this is a good return, this is a good cap. If you have some like rules of thumb of what's good, what's average, that would be really helpful to share as a follow-up, either through email or another session.
Yeah, definitely. Yeah, that's a good question. So yeah, I can put some thoughts down there.
Thank you.
And Caley, just from like a high level, it seems like to get this opportunity, you need the relationships with the lenders, you need cash, and then you need to be really good at evaluating the numbers that make sense, right? Would you say those are the three elements to be successful here?
Yes, definitely. I think for the relationship with the lenders, I think that you can build pretty quickly. Ultimately, they want your business and they want to work with you too. I think it's finding the person that can give you the loan amount that you want. And I have some intros that I can make, so hopefully it makes that a little bit easier. But yes, I definitely think the underwriting part is the most important. Like, you want to make sure that you're, conservative enough in your underwriting that you will make money, even if some of the assumptions are off. So I do think that is probably the most important part. And then the other part is, yes, cash as well.
Thank you.
And one of the things, and we'll close out here. I think first and foremost, thank you so much to Caley. It's an incredible amount of information that she has provided here, an incredible amount of insight. And yes, let's do another session where we can actually do some discussion, because I think that it would be great to hear some of Caley's additional thoughts, and also just to get some questions around here that folks may be thinking about. And yeah, so we'll end there. Thank you so much to Caley again. We'll do another session. Thank you all so much for being here, for being present. And I hope you have a beautiful day and a beautiful week. And we'll see you all soon.
Thank you, Caley.
Thanks, everyone.
Great.
Thank you.
Caley.
Thanks, Kaylee. Bye.